Chris, this one I think is for you. In the late 1980s, D&O insurance for bank directors specifically excluded FDIC coverage, which made it almost worthless. Do you see that happening again? And if so, what industries might face exclusion from regulators?
Yeah, I'm old enough to remember that a little bit, particularly in Dallas with the savings and loan world collapsing. Yeah, that regulatory coverage kind of disappeared around that time because of just the onslaught of claims. That has creeped back into the insurance coverage over time, into the D&O coverage, and many banks also buy what's referred to as bankers' professional liability, which is more of an E&O coverage for banks. So that's certainly something that we help our banking clients with. You're on mute, Francis.
Sorry, trying not to provide background noise. Beyond D&O, how should companies think of their banking relationship? When SVB failed, many companies were caught flat-footed, scrambling to make payroll. Mark, thoughts on that?
I think that's a tough question. I think most companies of some size have multiple banking relationships. Smaller companies, less so. And yet you can have significant funds in your payroll accounts. That's one reason I think that we're going to have to change the deposit insurance rules. I think that I would favor, for example, raising the ceiling on payroll accounts, or raising the ceiling. One of the areas where it's particularly troublesome are nonprofits, who many boards, I think, feel even stronger than for-profit companies that they need to be careful about having uninsured deposits at all. I don't think we want to go to a system in the United States where it's concentrated in just a few banks. So if we're going to preserve a multi-layer banking system, I think we need to look at some changes in the insurance rules. Until that happens, all I can say is that it probably makes sense to diversify your banking options so that you're not faced with having to open accounts. It's just a question of transferring money from one institution to another.
What are some tools that can help boards look around corners to identify future high-risk areas, other than a Ouija board?
Yeah, well, table game, it's kind of table war games, I guess, is the answer. Asking the question of what are we not thinking about that we should be thinking about? It's a hard question to answer. And like I say, there's a tendency to fight the last war, and the next war is a little bit unclear. So I don't know how to get at that, or how you formulate the games that enable you to see what nobody else can see.
That goes back, Francis, to your fear of the unknown, right? I mean, we're talking about financial risk management today, but I keep, harping on cybersecurity. That is a world that changes every day. ESG, I'm not sure everybody really understands what ESG means yet and what the implications are of that. So it's, things like what we're doing today, I think are fantastic in terms of keeping your eyes open.
Well, I will add a little bit to this because I have experience in it in my day job, but I also have experience with it in my director role. And as a director, we kind of combined a strategy and a risk effort together. And we actually brought in a third party to help us do some imagining. And interestingly enough, I will refer you to this Ben Cook article in the Wall Street Journal today. It's a very quick read, but it's quite interesting. It is about a professor that analyzed the whole social media, but the nuggets for me were right in the middle, talking about that these bank failures were as much a failure of imagination as anything else, just really not being able to look into the future and realize what could be coming down the path. And that's the point. It's again, it's the risk of the unknown. Well, we're all facing that as directors, and there's no predictability to it. But if you get the right people in the room, and by the right people, it may be various people within your company, and the collective dynamic of that, and the collective dynamic of knowledge sources, subject matter experts, combined with directors, and everyone discussing the potential of risks, it is amazing the things that you can think about and the impact of one thing against another. It to some extent is a play on a SWOT analysis, but it's not a true SWOT analysis. It's really trying to imagine into the future. And then having a third party facilitator help you pare back on those. I'm not saying that's for everyone. And we didn't spend hours on this. We did it in several sessions of about an hour and a half each. And it was extremely productive, extremely insightful. And I think we all walked away feeling that we learned something and feeling better about having, it's what I refer to as generative thinking. And you need to do it on a fairly regular basis. For our board, we always have an annual retreat where we're not discussing typical board matters, but we have topics that really are generative thinking, where we have an opportunity to think into the future, think strategically, and think about these types of things that we should be thinking about. So that's my 2 cents worth for whatever that might be helpful to you. So this is a great question. Do you think the risk at SVB was a known unknown or an unknown unknown? I'm not touching that one.
I think it was known. I think that one other element of being an outlier that I didn't mention was the depreciation in value of their securities portfolio. For most banks who have securities portfolio, obviously with rates going up, those have depreciated in value. If you look at the impact on capital for most banks have about 10% capital in relation as a percentage of their assets, equity as a percentage of assets. For most banks, if you took into account the depreciation in the bond portfolio, that would go down to 8%, 7%, maybe some banks to 6%. Silicon Valley was 0, went down from 10% to 0. So it was an outlier on that. And I think if you look at all those things in combination, you would say that this was something that was just waiting for somebody to light the match. Now, somebody doesn't always light the match, and therefore maybe you can get by with it. But certainly the ingredients were there for everyone to see, and it just took the match.
Yeah, and the only thing I would add, Mark, is, I mean, their client base was, very focused in the venture capital world with tech companies and fintech companies and biotech, and they grew very fast in the environment that we were in, and that was very much a known target of the bank.
The 3 greatest risks in banking are concentrations, fast growth, and credit as a broad matter, normally real estate. But concentration and growth are the biggest red flags you can have.
Well, to that point, as corporations move forward on establishing new credit facilities or renewing existing ones, what key factors should they be examining in choosing the lead bank and other banks taking positions in the credit facility?
I'm sorry, I didn't get that fully.
Sorry. As companies move forward, as they're establishing new credit facilities or they're renewing their existing facilities, what are the key factors that they should be considering and examining and choosing the lead bank and then other banks that will participate or take a position in the credit facility?
Well, there's a lot of issues in regard to that. I mean, surely you want your bank to be one that's financially stable. And there are ways you can judge that. You can't be a bank analyst, but most large banks have public ratings. And there's a variety of things you can go to judge that. I think, though, what you're looking at more importantly is how responsive is the bank? How have they dealt with problems when they come up? How have they successful are they in syndicating credits? So there's a whole variety of issues that go way beyond any thoughts about financial stability. I do believe that the need for participant banks tends to be left to the lead bank. Again, it depends on the size of the company. If you have deposit relationships with all those other banks, they may need to participate. So it really, I don't think there's any one size fits all. It really relates to your whole relationship and how responsive that bank has been and what its capabilities are with regard to what you need. If you're an international company, you need international capabilities. If you're very local, then you may not need that. And responsiveness and ability to deal with problems may be more important than anything else. So it really depends on the situation.
Chris, anything to add to that?
The only thing I would add as I was listening to Mark talk is some of the things that the D&O underwriters are asking. I mean, asking about concentrations of risk in any particular industry, or asking about, their agility to act quickly, what their investment portfolio management is, things that most boards and banks are already talking about, but it's ultra critical now.
We have somewhat addressed this question just in our earlier discussion, but I think it's one we could expand upon a bit. It was suggested that the skill sets of the directors on SVB's risk committee did not correspond to the role of the committee. Can you please elaborate on this? We had mentioned this in talking about governance, but it would be helpful for the audience to hear any specifics, Mark, from your standpoint of having been such a leader in the banking industry, and certainly Chris, with what you're looking at in terms of D&O insurance.
In terms of the abilities of the people that were on the risk committee?
The skill sets, in other words,
Yeah,
the
I think you need
credentials.
in today's world, I think you need a mix. You certainly need some people that have been in banking. And been in banking is a variety of things. If you're a relationship banker, you may not know all the details about the operations of a bank and the financial function of a bank. So I would say if it's a bank, I would say you need people that have been in the operations or financial end of a bank. But you also need tech people for sure, with the risk of cybersecurity and all of that entails. You need people that have a general management background, because a lot of these are just common. A lot of times you get common sense questions that the technical specialists don't really think about. So I think it's really a broad range, but you certainly need, and I think this is true of almost any industry. You need people that have industry experience. You need people that have technical tech experience, and you need broad gauge management experience. And I think those are the three, generally speaking, types of people you need on a risk committee.
Yeah, I'd agree. I'm not familiar with SVB's, makeup of their risk committees, but it's like Mark said. I mean, it has to be a tailored approach to whatever industry you're in, but it has to have a financial risk management, discipline and a privacy security discipline in all the areas that touch any particular company.
Okay, thank you. And I do think I'll just add again, the point of tailored to the industry is extremely important, so that that the skill sets of those individuals, that they really understand the industry, but they really also understand how, what are the factors that impact strategy and how to manage risks, both financial and reputational, that they're thinking about risk, not just in the current state, not just in the day-to-day, but also the future risks. And that's what we were talking about earlier in anticipating risks. So there are such a variety of experiences that are needed now because the breadth of risks are so great that what used to be considered risk is beyond just the usual kind of categories that we used to consider.
The other one I'd add for an international company is somebody with other directors with international experience, because
Right.
again, it's a whole different ballgame, and you've got to have people that have been in that arena.
And the reality is, to that point, geopolitical risk, policy
For companies,
risks,
please.
for companies that have high exposure to certain regulatory regimes or policies, both in the US or internationally. So it's all of those things. It really is a bespoke approach, but you certainly need people that have got deep financial experience and understand how to deal with those things and translate those risks, to the bottom line as well. Well, there's actually a question for me that deals with crisis tabletops and whether boards, should boards be involved in those, and if so, in what form? What I would say to you is obviously crisis management falls to the management team, but I would say that it is important for boards of directors to understand how that there is a crisis plan, and that there are scenarios associated with that crisis plan, that the company has really thought about this, that it's updated on a regular basis to reflect the current environment and current scenarios, that they are well prepared to address potential crises that are relevant to the company at that point in time, and that the board understands how they will be communicated with during a crisis, not that they will be asked to weigh in or participate in it, but how they will receive information, which usually should be through the CEO, obviously. And should there be a need for a board member to participate, usually the board chair or the lead director, how that would occur. Often a CEO may ask, depending on the type of a crisis, the CEO may ask for board input, but that is not the usual modus operandi. And boards should not think that they are actually going to play a role in the management of that crisis unless asked by the CEO. But what I always recommend conducting is what I call an executive and a board roundtable. So it's not what you think of as a typical tabletop, but it is about depending on the appetite of the group, a 30 to 45 minute roundtable just to walk them through an overview of the plan, how the communication chain will work, and how that will actually proceed, just so that they have a knowledge and an awareness. Sometimes this is done during a board meeting, just for a brief period of time. So, and I think that should be done on an annual basis. Happy to answer any follow-up questions to that, but that is how we typically handle it with our clients and what my experience. Now, I will also add on cybersecurity that I was asked as a director if we would like to participate in a cybersecurity tabletop for the bank whose board I sit on. And we were invited to actually participate. And we had about 8 or 9 directors participate in that. And they had a separate session for us because we really wanted to understand how that would unfold. And that was just an offer for us so that we could understand the intricacies of that. And it was a very nice offer, and we all enjoyed that. And so we could understand, obviously, for a bank, cybersecurity is a very deep concern.